Okay, let's look at the spreadsheet on all of these numbers now that we have the facts outlined. We can see that it's been made a little bit easier here because I've numbered all the lines that we're looking at. We'll just take it one by one so you're not too totally confused. We'll just start with line 1. These are all in thousands. So you have a bowling ball machine, which costs us $100,000, and these are cash flows, year 1, year 0, 1, 2, 3, 4, and 5. So cash flow, year 0, $100,000 negative outgoing, which makes it negative. So we've spent $100,000 for a bowling ball machine. And then if you look at years 1, 2, 3, and 4, there's no cash flow. That's 0. So there's no incremental bowling ball machines bought. And at the end of year 5, we have 2176 as a final number, and that's positive. Now there's an asterisk there, and the asterisk is there because I'm going to explain to you in detail how we came up with the after-tax salvage value of this machine. So basically it's the basis minus the cost that we sell, and if there's any taxes you have to take those out of it too. So having said that, we're going to push that off just for a second to finish this slide. So the number 1 was the bowling machine. It goes $100,000 out, and at the end we recoup $21,760 back, and when we sell it after tax. In number 2, we have accumulated depreciation. As I said, this is a Maker's Modified Accelerated Cost Recovery System depreciation schedule. So the first year we lose 20%. The bowling ball machine was $100,000. We lose 20% of that in depreciation. So the accumulated depreciation is $20,000. And then number 3 underneath it is the adjusted basis of the machine. The basis is what's left on the books. So the accumulated depreciation, we wrote off $20,000. The basis of the machine on the books is now $80,000 after the first year. This is the end of the first year. So we can see that this continues on across the slides. The second year we depreciate it down to $48,000. The third year we depreciate it down to $78,000. Fourth year, $17,000, and finally the fifth year it's depreciated all the way down to $5,760. That is the value that we hold on our books for the machine. That is not the value we sell the machine for, because the Modified Accelerated Cost Recovery System, Makers, has nothing to do with real prices. It has to do with how much you can write off on your taxes when you depreciate it. So we have $5,760 as our value, and we have depreciated it $94,240 with regard to our tax and income statements. Let's go past that. We have an opportunity cost here. The opportunity cost is the warehouse. We're using our own warehouse space, so we're not actually spending this money, but it is an opportunity cost. We lose $150,000 as if it was cash going out, because opportunity cost counts, as if it was cash going out in year 0. And then, of course, in year 5, we get the warehouse space. We could sell it. We could use it for something else. Therefore, the warehouse space is available, and we get the $150,000 back. Net working capital, very similar. We need more than the working capital we have, so we have $10,000 additional net working capital to fund this portion of the company, and that grows with our company growth. So we're going to sell more bowling balls over time. So it's $10,000 the first year, 16, 24, 21, and then it hits 0. Why does it hit 0? Because we've stopped the bowling ball line, we've sold off the equipment, therefore all of the net working capital can then be plowed back into the company. Therefore we have a cash balance on net working capital at the end of actually 0. And then the change in net working capital obviously is just the difference between the two. The first year is $10,000, the second year is $16,320, and the difference between the two is obvious, $632, and that just keeps going until we get the change in net working capital of $2122 in line 6. Line 7 is the total of cash flows. So the total of cash flows is line 1, 4, and 6. The other lines have been placed there to give you calculation variables. So the first thing that counts is year 0. So how much money are we spending out the first year? Well, we're buying a bowling ball machine, we have an opportunity cost for the warehouse, and we have a change in net working capital of $10,000. So it's $100,000 out for the bowling machine, $150,000 out for the opportunity to use the warehouse, and $10,000 out to increase net working capital. So it's $260,000 out in the first year. As you can see, the equation just moves along the bottom until we get to the in the first, second, third, and fourth year. And in the fourth year, you can see that it's $192,098. We get the warehouse back. We get our accumulated depreciation built back into the selling price of the bowling ball machine, and that gives us $21,000 back as positive cash flow. And of course, we get our net change in working capital back. So all of that comes back to a total of $192,98 that comes back at the end of year 5 because the bowling ball machine is no longer a part of our company. We've used its useful life. We started at year 0, we end up at year 5, and we put a bunch of money into the front, we get a bunch of money out at the back, and in between, hopefully, we've made some money. So that's the first part of the equation. There's more of this spreadsheet coming. But let me go back to one thing. As you remember, there was an asterisk at the 2176 on line 1, year 5. Line 1, year 5, 2176. If we go to that explanation, it's because we sold the bowling ball machine, even though we depreciated it down to $5,760. We sold it for $30,000. Oh, that's awesome. We sold it for $30,000 and we only had $5,760 on our books, but we have taxes to account for too. So let's walk through this. The capital gain is the difference between the ending market value and the adjusted basis of the machine. The adjusted basis is the original purchase price minus depreciation. So in our case, $30,000 minus $560 means our capital gain was $24.20. This is what we will pay corporate tax on. So the 34% corporate tax that is due is $82.40. The corporate tax that is due is $82.40. That's 34% times the difference in what we sold it for and what we had on our books. If you take the $82.40 off of the $24.20 after tax, you get the salvage value of $21.60. So the salvage value, the after-tax salvage value, is actually $21,760, which is what is reflected in the cash flows. So after we sold it for $30,000, we still have to pay taxes on it for $30,000, and therefore we need to include the difference between the taxes and what we had it for on our books. So if you think of it in terms of the way the cash went through, because it's you've got depreciation in here, right? That doesn't count. So the way the cash went through is we had a piece of equipment, we depreciated down, we paid the taxes on it. The taxes we owed were $82,240. 30,000 minus 82,240 leaves you with what cash is available to you after tax. But you had to first use the depreciation to figure out how much taxes you actually owed. So that's why this last line here is somewhat complicated. It's the $30,000 minus the amount of taxes that you paid on it, which is the $82.40, which leaves you with $21,760 as the after-tax cash flow value. And I know putting depreciation in there makes it a little more complicated. The reason you do it, of course, is because you can write off the depreciation. You don't want to pay taxes on that money. Otherwise, it'd simply be $30,000 minus 34% would be what your cash flow would be. But we throw the taxes in there just to make everybody's head ache a little bit more. So that's enough of this. That's lines 1 through 7. Let's go on to lines 8 and 9.